Most people think economic crises come out of nowhere. They don't. Crises follow patterns, they follow incentives, they follow systems that were quietly breaking long before anything else collapsed. And so today I am going to break down how economic crises actually work, why they happen, how they unfold, and what makes some countries resilient while others fall apart. Now, an economic crisis is not just a recession. It is not just inflation. It is not just markets failing or falling. A crisis is what happens when systems break, trust collapses, incentives misalign, shocks overwhelm institutions as well. A crisis is a systemic, not a synthetic, sorry, I beg your pardon. It is a systemic failure, not a single event. And every crisis has three components: a buildup, a trigger, and a cascade. If you understand these three, you understand every major crisis in history. I bet you. Now, starting with the build up phase. Now, crises don't just start with explosions, they start with pressure. First, excessive risk taking. Yeah, you have people, companies, or governments taking on more risk than the system can handle. Example Examples include too much debt, over-leveraged institutions, speculative bubbles, unsustainable spending. Risk builds quietly. Two, structural weaknesses. These are cracks in the system: weak institutions, fragile banks, poor regulations, ineffective or inefficient, I beg your pardon, industries, low productivity as well. These weaknesses don't cause crisis alone, but they make the system vulnerable. Three, misaligned incentives. Now, this is the silent killer. When incentives reward short-term gains, excessive borrowing, speculation, irresponsible behavior, you you always end up or get a system that looks stable on the surface but is rotten underneath. Four, loss of resilience. A resilient system can absorb shocks. A fragile system just cannot. Resilience declines when savings fail, buffers shrink, institutions weaken, trust erodes. By the time the build-up phase is complete, the system is a dry forest waiting for a spark. Now to the trigger phase. Now, a trigger is the event that exposes the weaknesses. Triggers can be a bank failure, a sudden drop in asset prices, a geopolitical shock, a natural disaster, a policy mistake, a loss of confidence. The trigger is rarely the real cause. It is simply the moment the system can no longer hide its fragility. And of course, to the cascade phase. Now, this is where a crisis becomes visible for everyone to see. Once the trigger hits, the system enters a cascade. That is a chain reaction of failures. One, liquidity crunch. People and institutions rush for cash. Credit dries up. Banks tighten lending. Businesses struggle to operate. Two, asset price collapse. Markets fall here. Investors panic. Confidence evaporates. Now, this is where fear becomes a force multiplier. Three, institutional stress. Weak institutions begin to fall. Banks, insurers, pension funds, large employers. One failure leads to another. For real economy impact. Now, this is where the people feel it. Job losses, business closures, reduced spendings, falling incomes. The crisis moves from financial markets to everyday life, hitting and touching everyone. Five, feedback loops. Crisis accelerate because falling markets or failing markets reduce confidence. Reduced confidence causes more selling. More selling causes deeper declines. This is the downward spiral. Now, crises don't end when markets calm down. They end when trust is restored. A crisis ends when institutions stabilize, liquidity returns, confidence rebuilds, incentives realign. The system here becomes resilient again. And so recovery is not just economic, it is psychological. Now, Some countries absorb crisis, others are destroyed by them. The difference is resilience. Resilient countries have strong institutions, diversified economies, high talent density. And if you have been following me, you know how heavy I am on talent. I take talent heavy, seriously, because talent is the most important resource we ever have on earth. Don't let anyone lie to you. We also have trusted leadership, social coherence, long term planning. Fragile countries evidently have the opposite. Now, let me clear up a few myths. Myth one, crises are unpredictable. That is false. The timing is unpredictable, the vulnerabilities are not. Myth two, crises are caused by one event. That is false. Crises are caused by years of buildup. Myth three, crises are purely economic. False. They are psychological, institutional, and structural. I end this very live session by saying economic crises don't break systems, they reveal which systems were already broken. And with that, I know and I hope, not I hope, I know this was very easy to understand. And so, thank you so much for coming across this video and taking time to watch. I know it is a very important subject that everyone should understand. We should understand that economic crises are not magic. They are structured crisis, if I should say that. And so you can always push in your comment, any comment that you have. Um, that is after you see this video, and take it from there. Thank you so much for watching.